Hey everybody, welcome to Things You Should Know, Accounting Edition. Today we're going to cover two smaller subjects, the chart of accounts and what the difference is between permanent and temporary account. We're going to need this knowledge before we step forward into the general ledger, which will be next video. First, the chart of accounts is a comprehensive list of all the accounts used by business. In our case, at Jello's Coffee Shop, we'll list all of his accounts here as listed. Each account is given a number and a name. There is a specific numbering system for these accounts. It's a standard accounting practice. The first accounts listed will be those associated with the balance sheet, then we'd follow up with accounts that appear in the income statement and owner's equity accounts. The number assigned to the accounts are based on what type of account it is. The list of accounts is as follows. Asset accounts will be labeled 100 to 199, liability accounts 200 to 299, owner's equity accounts 300 to 399, revenue accounts 400 to 499, and expense accounts 500 to 599. Not to worry, it may seem like you're only limited to 99 accounts for each section, but you can actually break these down to be 100.1, 100.2. Some of the government agencies I used to audit would break it down to a 3-point decimal system for each, so they had enough to cover all the accounts. Okay, so you'll notice this is Jello's Coffee Shop chart of accounts. You will see that they are listed. The 1 to 199s, I've listed all of the asset accounts. I've given them each one their own number. Same with the 2 to 299s, the liabilities like the accounts payable and the short-term loan that Jello still owes. Of course, Jello's equity is a 300 level account, and that finishes out the balance sheet accounts. And like I said, the next step would be owner's equity and income statement accounts. So owner's equity, Jello's drawing account, of course, and then the income statement would all be the revenues and expenditures. So you got the revenues and the expenditures. You'll notice I have not consecutively numbered these accounts. This is because I want to leave room in case in the future I need to add accounts. A lot of times when you start a business, you might only have a few accounts. Give it a few years, you might have hundreds of accounts. When we have revenues, there might be 99 possible revenue slots, but you might want to have different types of revenue kind of grouped together. Let's say I want to start selling dinner, so we're going to have food revenue. We might make that 402 because it's closely associated with the coffee revenue, or you could even break it down to what type of coffee, etc. So I usually keep them broken up like this. So as I add new accounts, if something is closely associated with coffee revenue there, or perhaps the fundraiser revenue, perhaps I start getting specific types of revenue I want to track. This means we can go make it 408, 409, or once you get really big, it could be 407.2. Okay, so that's just the basic coverage of our chart of accounts. You'll list each one of these accounts, and you'll notice the name of the accounts equal the names of our T accounts. Of course, not with the parentheses. That was just for your example. Now, another thing to know about these accounts, there's permanent and temporary accounts. We list all the accounts in chart of accounts, but some are permanent, some are temporary. All balance sheet accounts are what we consider permanent accounts. These balances are carried forward between different accounting periods. Say at the end of the year, the asset values for you have $150,000 in cash at the end of the year. The beginning of the next year, the next period, it'll stay $150,000. These stay permanent. They are adjusted, but they roll over between accounting periods. Temporary accounts are comprised of income statement and owner equity accounts. These accounts track changes during the accounting period. The revenue tracks how much money Jello made during that year, while the expenditures track how much Jello spent. These accounts classify and summarize changes to the owner's equity during the period. These are nominal accounts because these balances are transferred to the capital accounts at the end of the accounting period. At the beginning of the next accounting period, these accounts are zero. December 2014, Jello may record something like $1 million in revenue. The beginning of the new year, this account gets reset to zero because everything at the end of the year gets transferred. So to go from whatever excess revenue here gets rolled over to cash or whatever appropriate section to go to. You'll have all your assets will be in the 100s, all your liabilities will be in the 200s, owner's equity in the 300s, income statement revenues will be in the 400s, and the expenses will be in the 500s. Well, that's it today, folks. That was a really quick rundown. I just wanted to go over this briefly so next week when we start talking about general ledgers and journal entries, you'll understand what I'm saying when I refer back to your chart of accounts. Well, I'll see you guys at the next video. Take care.